Silver sits at 78.50. ComEx just lost 3 million ounces in 48 hours. Registered inventory now stands at 90 million. But paper claims 295 million ounces. The CPI report dropped this morning. Silver spiked, then got slammed back down within 30 minutes. The result? Only 800 contracts closed, only 1.5 million ounces extracted from SLV. Shanghai remains closed until February 24th, 22 accounts suspended for manipulation before the closure. The premium held at $9. March delivery deadline is 12 days away. The question isn't whether the system can handle this. The question is what happens when it can't. Welcome to AU and AG. If you've been watching markets long enough to remember when gold was $300 an ounce, when silver was $5, when central banks actually backed their currencies with something real, then you understand why this channel exists. We don't chase headlines here. We analyze structure. If that resonates with you, if you value clarity over noise, take a moment and subscribe. Not for entertainment, for information that matters. And tell us, where are you watching this from today? Are you in the States, Europe, Asia, somewhere watching physical premiums diverge from paper prices in your own region? Drop your location in the comments. Let's see how global this audience really is. Now, let's examine what just happened in the silver market, and why the next 6 days might determine whether this system holds together or fractures under its own weight. On Monday morning, February 14th, 2026, silver traded at $78.50 per ounce. Futures contracts sat at $78.75. To the casual observer, this appeared stable, a consolidation phase after recent volatility, but beneath the surface, something else was happening. Something most market participants weren't paying attention to. The Shanghai Futures Exchange remained closed for Chinese New Year. Before the closure, Shanghai spot silver traded at $86. Futures contracts at $88. That created a $9 premium. $9 for the same metal, the same ounce of physical silver. And here's what matters. This tells a story about physical demand in the East that most analysts choose to ignore. But the real crisis wasn't happening in Shanghai. It was happening at ComEx, the commodity exchange in New York, the place where most paper silver contracts get traded. Over a 48-hour period, ComEx registered silver inventory dropped from 93 million ounces to 90 million ounces. 3 million ounces gone. Withdrawn from registered vaults. The vaults were bleeding inventory at an accelerating pace. Now, 90 million ounces of registered silver might sound like a lot, until you compare it against the open interest in March contracts. 59,000 contracts remained open. 59,000 contracts multiplied by 5,000 ounces equals 295 million ounces. 295 million ounces in paper claims, 90 million ounces of registered physical metal. The coverage ratio had just deteriorated to 3.3 to 1. For every physical ounce sitting in ComEx vaults, there were 3.3 ounces worth of paper claims against it. This wasn't normal. Even by ComEx standards, this ratio represented extreme stress. In previous delivery months over the past decade, coverage ratios typically stayed above 5 to 1, sometimes 6 or 7 to 1. The system had buffers, room to maneuver, options for managing delivery pressure. But 3.3 to 1? That left almost no margin for error, and the inventory wasn't stabilizing. It was accelerating downward. The technical picture added another layer to this situation. Silver had crashed to $74 just days earlier. That level held, exactly where technical analysis suggested support would form. The bounce from 74 brought price back to 79. But resistance formed at $81. The 150 exponential moving average on the hourly chart sat right at that level. Price had tried to break above it, failed, pulled back. Now, silver consolidated in a range between $77 and $79. Range-bound, neither breaking down nor breaking out. Just waiting. For most traders, this looked like typical consolidation after a volatile move. Nothing unusual, nothing alarming. But when you layer the inventory data over the technical structure, when you see registered silver dropping 3 million ounces in 48 hours while price remains range-bound, when you recognize that March open interest barely budged despite recent volatility, the picture changes. Because here's what the data revealed. Despite a crash to $74 designed to shake out weak hands, despite the recovery and subsequent compression back down, despite all the volatility and all the paper market pressure, March open interest only dropped by minimal amounts. The holders weren't selling. They weren't rolling their contracts to later months. They were sitting there, waiting. 59,000 contracts, 295 million ounces worth of claims, against 90 million ounces of physical metal. This raised a question that nobody in mainstream financial media wanted to address. What happens when multiple futures exchanges face physical shortages at the same time? Because ComEx wasn't alone in this situation. Shanghai had closed with 353 tons of physical silver in their vaults, approximately 11 million ounces. Their combined open interest for February and March contracts, 360 tons, essentially one-to-one coverage, no buffer at all. So while ComEx struggled with a 3.3 to 1 ratio, Shanghai faced a 1-to-1 scenario. Two major silver futures exchanges, both running dangerously low on physical inventory, both facing delivery pressure in the coming weeks, both operating in a market where the $9 premium between East and West hadn't collapsed despite one exchange being completely offline. The inventory crisis wasn't just a ComEx problem, it was systemic. And the next 6 days, while Shanghai remained closed, would reveal whether the paper market could maintain control, or whether the physical shortage would force a reckoning that decades of derivatives leverage had managed to postpone. February 14th began like any other data release morning. Traders positioned themselves, algorithms stood ready. The markets waited for the Consumer Price Index report. The number dropped at 8:30 a.m. Eastern Time. Core CPI came in at 0.2% month over month. The consensus had expected 0.3%. Year-over-year inflation printed at 3.1%, slightly below the 3.2% forecast, cooler than expected. In theory, this should have been bullish for precious metals. Lower inflation typically means the Federal Reserve has more room to cut interest rates. Rate cuts traditionally support gold and silver prices. The initial market reaction followed the script perfectly. Silver spiked from $78 straight up to $79.20, a $1.20 move in seconds. Volume surged. Algorithms triggered buy programs. For exactly 17 minutes, it looked like a genuine breakout attempt. Then something happened. Something that revealed more about market structure than any official report ever could. Within 30 minutes of that initial spike, silver got slammed back down to $78. Not gradually, not through normal profit-taking, through coordinated selling that erased the entire move as if it never happened. The whipsaw was complete. Spike up, hammer down, return to range, business as usual. But here's where the story gets interesting. When a major macroeconomic catalyst hits the market, when inflation data comes in better than expected, the volume should reflect genuine market participation, institutional flows, hedge fund repositioning, real capital moving. That's not what happened. The volume during the entire CPI volatility episode was pathetic. Thin, almost non-existent compared to the price movement. This revealed something critical about how modern markets actually function. When you see dramatic price swings without corresponding volume, When the moves happen too fast and too coordinated to represent organic buying or selling, when the pattern repeats itself across multiple similar events, you're not watching a market, you're watching an algorithm, or more accurately, multiple algorithms executing a predetermined playbook. Let the price spike just enough to trigger stop losses and momentum traders. Capture that liquidity, then reverse the move before any real institutional capital can reposition. Compress price back into the range. Mission accomplished. Except this time, the mission didn't accomplish what it was designed to accomplish. Because the real objective wasn't just to create volatility. The real objective was to shake out contract holders, to force long positions to close, to reduce the open interest in March silver futures, to relieve the delivery pressure building at ComEx. So what actually happened? How many contracts closed during this orchestrated chaos? 800 out of 59,000 total contracts in March open interest. 800, 1.3%. Despite perfect conditions for a mass liquidation event. Despite the spike that trapped late buyers at 79.20, despite the subsequent crash that triggered stop losses below 78, despite all the coordination and all the algorithmic firepower deployed, only 800 contracts closed. The remaining 58,200 contracts sat there, unmoved, unshaken. Welcome to the Silver Truth, where we don't just report market movements, we decode the strategic forces behind them, still waiting for delivery. But the shakeout attempt didn't stop at futures contracts. There was another target, SLV, the iShares Silver Trust, the largest silver exchange-traded fund in the world. The fund held approximately 488 million ounces of physical silver. When prices get volatile, shares of SLV get redeemed. Authorized participants can exchange SLV shares for physical silver. This mechanism allows banks to extract physical metal during moments of panic. During the CPI chaos, redemptions occurred. 1.5 million SLV shares converted to physical. Approximately 1.5 million ounces extracted. Add that to the 2 million ounces pulled during the previous shakeout at $74. Total extraction over 48 hours, 3.5 million ounces. Now, 3.5 million ounces sounds significant. It sounds like the shakeout worked. Until you remember what we're actually dealing with here. ComEx has a 205 million ounce shortfall. 295 million ounces in paper claims against 90 million ounces registered. The deficit is 205 million ounces. And after two major coordinated shakeout attempts, after crashing price to $74, after the CPI volatility whipsaw, after algorithmic spoofing and coordinated cross-market selling, they extracted 3.5 million ounces from the world's largest silver ETF. 3.5 million against a 205 million ounce hole. Less than 2% of what's needed. This is where the narrative starts to crack. Because if you control the paper market, if you have unlimited derivative leverage, if you can create synthetic supply through futures contracts and ETF arbitrage, why are you only extracting 1.7% of the shortage? Why are you extracting so little after throwing everything at the market? The answer sits in the SLV shareholder data. Retail investors panic during volatility. They see red numbers. They sell. They redeem shares. But SLV's major holders aren't retail. They're institutions, pension funds, asset managers, entities managing billions in allocated positions. And those institutions, despite the $74 crash, despite the CPI whipsaw, despite every attempt to create panic, they weren't budging. 488 million ounces remained in SLV. Only 3.5 million came out during maximum pressure. The institutions were holding tight. The question nobody wanted to ask out loud was simple. Why? What did institutional holders understand about this market that retail participants didn't? What were they waiting for? And how long could ComEx maintain paper price control when each successive shakeout produced diminishing returns? While registered inventory continued bleeding at an accelerating rate? This isn't just a market movement, it's a structural shift. If you value this unfiltered economic intelligence, join us. Like, subscribe, and let me know in the comments. Are you holding with the institutions? This is The Silver Truth. Welcome to The Silver Truth, where we don't just report market movements, we decode the strategic forces behind them. 7,000 miles from New York, another story was unfolding. A story that most Western analysts either missed entirely or deliberately ignored. A story centered in the heart of the East, the Shanghai Futures Exchange, one of the world's largest commodity trading platforms, home to some of the most aggressive physical silver buyers on the planet. But something changed on February 5th. On February 5th, Shanghai went dark. Chinese New Year celebrations. The exchange would remain closed until February 24th. 8 full days of no trading, no price discovery, no Eastern buyers participating in the global silver market. But the closure itself wasn't the story. What happened in the week before the closure, that was the story. In the 7 days leading up to Chinese New Year, the Shanghai Futures Exchange suspended 22 separate account groups. 22. In 1 week. For trading violations. This wasn't normal enforcement activity. Shanghai regulators typically handled violations quietly. Fines paid, warnings issued. But 22 account suspensions in 7 days represented something else entirely. The official violation? Article 16 infractions. Coordinated manipulation during overnight futures sessions. Now, most people read that and move on. Trading violations happen. Exchanges enforce rules. Nothing unusual, except when you dig into what Article 16 enforcement actually disclosed, the picture becomes much clearer. These weren't random traders making mistakes. These were organized groups executing coordinated trades during very specific windows. Overnight sessions. When liquidity thinned out. When most Asian traders had gone home, when volume dropped to levels that made price movement easier. And here's the part that changed everything. The enforcement documentation explicitly referenced coordination with US traders, Western entities, working together. The strategy was elegant in its simplicity. Wait for overnight sessions. Execute large sell orders to push prices down. Create the appearance of genuine selling pressure. The arbitrage opportunity that normally existed between Eastern physical demand and Western paper prices got compressed. Not through market forces, through coordination. Shanghai regulators saw it, documented it, and suspended 22 account groups in 1 week. Then they did something even more telling. They closed the exchange for 8 days. Now, Chinese New Year happens every year, but the timing of these suspensions, followed by an 8-day closure, that was strategy. Shanghai essentially told Western banks, we see what you're doing, we've documented it, and now we're removing ourselves from your market for over a week. Stay ahead of the strategic forces. Like and subscribe to The Silver Truth for more unfiltered economic intelligence. This content is for educational purposes only and not financial advice. Welcome to The Silver Truth. Today we're decoding the Shanghai silver closure, a move that gave Western banks free rein to manipulate paper prices for 8 days. While Shanghai sat offline, algorithms traded against algorithms with no physical buyers to absorb supply. The perfect environment for maximum price suppression. But here's the math. Shanghai has 353 tons of physical silver against 360 tons in claims. With a 1-to-1 ratio, there is absolutely no room for error. The $9 premium in Shanghai signals real demand. Chinese buyers want actual metal for solar panels and tech, and they stand for delivery every time. On February 24th, the truth reasserts itself. If you value this intelligence, please like and subscribe. As always, this is for educational purposes only. 6 days remained until Shanghai reopened, 12 days until the March 27th delivery deadline at ComEx. Two separate timelines converging toward the same question. What happens when paper claims exceed physical supply and nobody blinks? The situation was clear. Silver trading at $78.50, stuck between 77 and 79. Range-bound, consolidating. The $81 resistance overhead like a ceiling. The $74 support below like a floor, waiting for the next directional move. But this wasn't a standard situation. While participants watched charts, the underlying structure was deteriorating fast. ComEx registered inventory sat at 90 million ounces, down from 98 million just a week before. The trajectory is accelerating downward. Every day brought new withdrawals. Every week brought larger outflows. And March open interest barely moved. 58,000 contracts, 291 million ounces in claims, against only 90 million ounces of physical metal. The ratio had worsened to 3.2 to 1. Now ComEx has managed delivery pressure before, for decades. The exchange has tools, cash settlement options, force majeure clauses, political connections to ensure regulators look the other way. In 2020, JP Morgan paid a $920 million fine for manipulating markets. They pleaded guilty to criminal charges. Then the same traders returned to the same desks. Nothing changed. The system absorbed the fine and continued exactly as before. So why would this time be different? Why would March 2026 be anything other than another managed delivery month, where longs roll their contracts forward and ComEx shuffles inventory categories while paper price control remains intact? The difference is in the numbers, not the technical charts or moving averages, the physical inventory numbers. This 3.2 to 1 coverage is the worst ratio in modern ComEx history for a major delivery month. It's unprecedented. Previous tight situations had higher inventory levels or more time to manage. But this time, the runway is shorter. The pressure is higher. The paper market is hitting a wall. Welcome to the Silver Truth, decoding the strategic forces behind the market. Subscribe for more unfiltered intelligence. Welcome to the Silver Truth, where we don't just report market movements, we decode the strategic forces behind them. This crisis had none of the traditional buffers. 90 million ounces of ComEx registered silver, falling daily, against 58,000 contracts that refused to roll despite two major shakeout attempts. And here's what made the situation even more unstable: Shanghai's one-to-one coverage. In previous years, when ComEx faced delivery pressure, there was always an escape valve. Arbitrage flows could redirect physical metal from Shanghai to New York. The global market had flexibility, multiple sources, multiple delivery points. But when Shanghai closed with 11 million ounces against 11 million ounces in claims, when their own exchange faced the same delivery pressure ComEx was experiencing, the safety valve disappeared. There was nowhere to source emergency inventory, no way to move Eastern physical supply to Western delivery obligations. Both exchanges, running on empty, simultaneously, for the first time in modern market history. The next 6 days would reveal the effectiveness of one final suppression attempt. Western banks had a window while Shanghai was offline. No competition for available ounces. Free rein to use every tool in the manipulation playbook. The $74 support level became the target. If price crashed through 74, stop losses would trigger. Margin calls would force liquidations. panic would spread. Weak hands would fold. Maximum fear, right before the March delivery crunch. That was the strategy. The problem was, it had already been tried. Twice. Each successive attempt produced diminishing returns. More effort, more coordination, more algorithmic firepower, but less result. The system is approaching a threshold where it can no longer be controlled. March 27th is the delivery intentions deadline, the day when contract holders must declare their choice: physical delivery, roll to a later month, or accept cash settlement. At current ratios, ComEx simply cannot deliver to everyone who chooses physical. The math doesn't work. Whether they refuse delivery, drain registered to zero, or perform emergency registrations, all three outcomes share one characteristic. They prove that the physical shortage is real, that paper leverage has finally exceeded supply. Long-term, that is incredibly bullish. Once trust in paper contracts erodes, the premium for physical metal will explode. London, Zurich, New York, premiums could hit $20 or $30 over paper spot as paper is recognized for what it is, a promise that can't be kept. The premium tells the truth, not the paper price, not the algorithmic movements. When buyers in one market consistently pay $9 more per ounce than another for the exact same metal, that reveals real preference. Physical over paper. Metal in hand over promises on a screen. The next 12 days will prove whether that preference is strong enough to break the system or if there's one more managed delivery left. Either way, the inventory is bleeding and the coverage ratio is worsening. Mathematics is finally overwhelming manipulation. The clock is running, the inventory is draining. Capital preservation first, survival during volatility. I'm your host for The Silver Truth. Stay sharp and stay positioned. We'll see you on the next deep dive.